and worked my way through, ran the national sales team for Interbay Funding. So anyone that did commercial lending, um, that's what we did. Did some financial planning, insurance, but 2008 hit after Interbay, and I actually brokered for 3 years out here in Durham. So yeah, I'm out here in Durham region, by the way. I am in Ontario. I'm the only remote employee for our company since our head office is out on Vancouver Island. So just that's a little bit about me. I worked for Home Trust for 3.5 years before joining FISGARD. So when it comes to you guys doing your business, I totally get it. And I am more than happy to help you guys, whether it's having conversations with clients, planning, generating leads, things like this. So what I'm going to say to you, because if you're on this call, I'm assuming you want to learn a little bit more about private. And if you're doing some already, great. If not, you're probably trying to figure out how to do it. And I actually saved this. So I saw a great quote yesterday. I was on a coaching event that was held by one of the other networks. And so I'm just going to read this quote because I didn't put it in my presentation. But it goes like this: if you don't have enough leads, you don't have a lead problem. What you do have is you have a marketing problem. So it's not a matter of what kind of business that you're looking to do, whether it's mortgages or any other industry. If you're trying to generate business, it's all about marketing and how you market yourself and what you do to generate the leads. It's as simple as that. So we'll get into that. Hopefully through this presentation, what we're going to do, I'm just going to share my screen here, and we're just going to keep it pretty tight to the timeline. I want to respect your time. And can you guys see that, Scott? Yeah? Okay. So let me just go into presentation mode here. So you'll learn a little bit about who FISGARD is, because it's important to know who you're sending your clients to, because I almost guarantee you at some point, they will ask you, like, who the heck is FISGARD? Because that's just what clients do. So let me explain a little bit about them. We'll get into, everyone wants to know about products, absolutely. And but more importantly, I want to talk to you guys about kind of what to look out for, what to avoid to help protect your business and your clients at the same time. And we'll get to that towards the end, at least. So just a little bit of background here. And there's reasons we have pictures up on this slide, because I think it's important you know who you're actually dealing with. So FISGARD, we've been actually in business for 26 years now, started by Hallie's father. And we are still a privately held mortgage investment corp. We're one of the most respected right across Canada. And a lot of people do come to us for different ideas and advice as well. But we primarily do residential first and seconds, as well as the commercial and construction. So we'll get into that in the presentation shortly. But one of the things is the strength is our people. Hallie and myself look after the broker channel from BC to Ontario. We don't lend east of Ontario, but we're more than happy to talk to all the brokers across the country. And for that reason, because if you do have a deal that lands within any of the provinces we lend in, we're more than happy to help you. Rafer looks after all our commercial and just corporate business there. Joanne is an important person for you to know, because it's her and her team that actually underwrite your business. So when the file goes in, it's Joanne that and one of her team members that kind of pre-flights everything and then takes care of it. And they're in touch with you from start to finish. So that's an important piece. It's not bouncing from underwriter to underwriter to underwriter. Forgive these guys back here, by the way. I couldn't wake them up, so I had to leave them there.
There's two of them now, eh? Jeez.
There is two.
I thought I saw the one jump in.
So listen, before we get into it, I want to let you know kind of where we fall into the landscape, and we talk about the bucket of mortgage money. There's only so much money to go around. We're a mix, so we have a certain amount of capital, and this is where we fall into play. So you have your TDs, your Scotias of the world, and some of the other banks that are starting to re-enter our space. You also have your B lenders. So when we talk B, we always talk about traditional alt lenders, your home trust, Equitables of the world, but we'll throw in the trust companies, credit unions, and the monolines or mortgage finance companies. This is where we fall into play. Anything that's turned down by any one of those lenders, um, we want to see. I would love to hear from you because we might be able to help out. In the landscape, we're really considered that C to C plus lender. So winter's coming, we give you lots of vitamin C, we keep you healthy, we take care of you and your mortgages and your clients. Aside from that, you have all the other mix that are out there, all the other private individual investors. It could be any one of you on this call, and syndicators. If you're not sure what a syndicator is, it's really as simple as two people coming together to facilitate the funding of a mortgage. So, if funding requires $100,000, two people have $50,000 each, and they come together to fund that. That's syndication, and it can go to literally thousands and thousands of people depending on the scope of the project. So again, just a little bit of idea of where we stand. So why use us? One of the main attractions on our residential first and seconds is the fact that we don't charge a lender fee, and that our product is fully open after the first 60 days on the residential product. So first or seconds, doesn't matter. I'll get into everything else. These are all separate slides, but it'll give you an idea of why. And just so you know, a number of these items we actually created during, and specifically because of what happened with COVID and people being thrown out of work, forced to close down their businesses, but they had great equity, they had, great credit, everything else, and some don't, but we'll get into that as well. So advertisements, let's talk advertisements. I get them all. I talk to most of the mix in Canada, or in Ontario specifically. Um, if you're getting an advertisement and everything's about rate, I want you to read the fine print. As a professional, our job is not just to look at the headline. You need to dig deeper into the fine print. So if you're seeing an ad for, let's call it $4.99 or $5.99 plus a lender fee, I want you to ask yourself, is it a 1-year term or is it a 6-month term? I just saw an ad the other day on LinkedIn and they gave a great rate. Luckily, they were transparent and they said it was actually for a 3-month term. And you really have to think about that. Like, how quickly can you exit your client? And if you can't, what actually happens at the end of that term? What do the terms look like? And I'll give you some examples on those too. But for us, we're a 1-year open term or a 2-year term. And the way this works, as you can see very well laid out here, is no interest penalty after the first 60 days to pay us off within the first year, the 1-year open term. At the end of the 1 year, if the exit doesn't work, the client's paid us on time and the values are still there or better, we can offer a renewal. And we do not charge a renewal fee to get them the second year. So that's really, really important. The reason I mention this is I've seen renewal fees from other operations out there ranging anywhere between $10,000 to $20,000. And it's honestly, it's crazy, but that is their business model. And it's up to all of us to actually understand it. And I've been cataloging a lot of this stuff as I come along across it, just for information purposes, because we need to understand how a company works and how they make money. With our 2-year option term, the reason we came up with this and didn't go 6 months, because within our 1-year open term, you have the option at 3 months, pay us off. There's no interest penalty. At 6 months, at 9 months, doesn't matter. For a 2-year, why would you do a 2-year term? Clients coming out of bankruptcy, they're coming out of a proposal. Maybe they've set up a new business that they wouldn't qualify for with the B lenders or the A lenders. Put them into a 2-year term. And for the first year, it is closed with a 3-month interest penalty if they were to pay us off. But the minute the second year starts, it's fully open without an interest penalty to pay us off or pay us down. So if they only need it for, 14 months, 18 months, that's fine. There's no interest penalty to pay us off. But the rate for both the 1 and 2-year term are the same. So you've got a rate guarantee right through the full 2 years. Now you'll see a common theme here, best of all, no admin fees, no application fees, no retainer fees. We do not, our business model does not operate like that. So that there are certain times where we may charge a lender fee, and that's with specifically rental projects or flip projects. We charge a lender fee with our commercial and our construction program, to give you an example, but not on our residential programs. So straight equity program, this came out of literally, we created this year and put a name to it. When you put a name to something, everyone gets excited. So we were actually doing this, but we realized, yeah, let's formalize it and put a name to it. So you have a straight equity program up to 65%, first mortgages only. The rates, that rate range, we actually reduced a little bit based on our fourth quarter promo that we're running right now. As you can see, values at $1 million. If you have a value slightly over $1 million and it's still 65% loan to value, let me know. We can work with that. And also keep in mind a minimum of 580 as a credit score for at least one of the applicants. If they meet this criteria, we're not asking for income docs or job information or anything like that. We still expect, though, here's what we expect: a full application. Number one, we do have an appraisal requirement on all our deals, but definitely a fully completed application. That's a basic expectation from us, so that our underwriters really understand what's going on with that client, what the story is, why they're in the situation, what's changed potentially, and basically why won't it hopefully happen again, along with the exit strategy. Those are common themes we want to see throughout any sort of deal presentation. Okay. Second mortgage product is another one that we didn't create. We've always done seconds, but what we did was at the beginning of this year, there was a change, a significant change. Because if you called me last year and said, "Hey, I've got a first mortgage, but it's a collateral charge," and the registration was for 100% of the value, I would have said, "Sorry, I'll refer you over to someone else in the mixed space that's happy to do something like that." Very few. But at the beginning of this year, we're able to now to go in behind a collateral charge on the outstanding balance, not the registered amount. So big difference there. So your client may have bought, let's say they bought 4 or 5 years ago, 500,000. That's the registration, 100% of value. The value is now jumped up to 700,000, 800,000, but the mortgage balance has come down to, let's say, 400,000. There's lots of room in there now for us to come in behind that $400,000 balance outstanding. Another one coming in. I love it. Keep them coming. Bridge financing. This is another one that for the last, I would say, 2 years, we're in a hot market, as we all know. It's throughout Ontario. Unless you're downtown Toronto, there's, it's softened a little bit, but people are ultimately purchasing first now, and some, as we know, are going in firm on their purchase without even having their current properties sold. And what they're finding now is that the dates are not lining up for whatever reason, and that's okay. 3 scenarios here that I have listed out, we can help in all of these scenarios. So I want to make sure you guys understand, you do not need a firm sale on the existing property. And the existing property doesn't even have to be listed yet for us to be able to do bridge financing. Typically, what we'll do is we'll look at what the maximum is that we can do on the purchase, and then the difference we'll pull from the existing property. We blanket both properties, and then we go from there. We ask for a minimum of 60 days interest. We don't charge a lender fee, but we ask for a minimum 60 days interest. And the rate range is anywhere between 8.5 to 8.99. So if you're to compare almost everyone else out there, they're going to charge minimum 1% to 3% as a lender fee right off the top. So in comparison, we're asking for it on the back end. So if the client only needs it for 30 days, at payout, what they owe us is the other 30 days to make up the total of 60 that we're looking for. Okay, so I hope we're clear on that. If you guys have any questions, just type into the chat, and maybe Scott, you can monitor that, and we'll afterwards. Okay.
I'm taking a look at it right now. I think there's like, I know Zainab just came on, so there'll probably be some questions too coming up. So that's great.
I don't have a 12-year-old or anything, but you know, this slide, I went back where I just became young again. That's property types, condos. So let's talk residential property types. So condos all the way through to a 5-plex, we can actually consider under our residential property program. Sorry. Once we get over 6-plex, then it goes multi-residential, and that falls into our commercial lending side. And like I said, the main difference between residential program and commercial program is that we charge a lender fee on the commercial program. Let me jump into here. So we'll talk a little bit about all 4 categories. Residential first, I want to make sure we're clear on this. So rental properties, if your client has multiple properties, we actually don't have a limit. So the max that I've come across was a gentleman that owned 100 rental properties in the city of Sudbury. And they wanted to buy another property, which was outside of our lending area up there. And, you know, of course, the question was, do you have any other properties? And that's when we found out they did. So we just took, we blanketed a few of them to get them the money he needed to purchase that other property. So just as an example, rentals are fine. We allow our max LTV, and I'll get into it in the next slide, but our max LTV, first or second residential, is 75%. We allow you to bring secondary financing up to a max of 90 if needed. So that's third-party secondary financing. If you don't have a source, we have MICs and other private lenders that will actually come in behind us and make up that 80 to 85%. And we're also working on some bundle partners as well. So the resources are there to make sure you get that deal done. And keep in mind, we're doing the first 75, let's say we do the max, with no lender fee. The other portion will have a lender fee on it for the second mortgage amount. Minimum loan amount, as you can see, 30 grand and 1.65 million. That's based on a tiered lending approach. What I'm going to do is I'll send Scott out and Susan, I'll send you guys out a detailed email that addresses all of this stuff so that the team has it as a reference point along with the attachments as well. Residential seconds, we talked a little bit about that, but main points here: owner occupied only, second position with to institutional lenders, and the seconds we will not go in behind a first larger than 850,000.
Hey, Reaza, sorry to interrupt you, just because I don't want this to take off topic, but we have a question quickly. Is that okay?
Yeah, of course.
Cool. So it says Bob 2 owner is thanks for the informative presentation. My client is purchasing a property. He requires 100% loan with a blanket on his existing property. The existing value is 1.2 million with only 600K mortgage on it. Would you consider this? That's just kind of a deal question. I know that was off. It's just part of
so that's more of a bridging type of scenario then, from what I'm hearing.
Yeah.
So the answer is yes. We can pull maximum, so up to 75%, depending on where it's located. We can pull up to 75% from the existing property, and then we can look at the maximum would lend hopefully 75% on the new property to get them the full amount of money that they need. Because if the down payment is coming from the sale of an existing property, we have no issues. The client owns that money. One of our stipulations is in purchases, just a straight out purchase, we ask that the client come in with a minimum of 10% of their own funds. So if the own funds are coming from the existing equity of a property, we're fine with that. And we're happy to mortgage that. But we will not go 100% LTV as long as it's within our max LTV. I hope that answers the question.
I'm sure it would, but I mean, I'm sure you guys can connect after the presentation too. And I'll make sure I'm going to wait for these questions until the end now, just to make sure we can do it all then. Sorry to interrupt your presentation.
Yeah, absolutely. And my contact information will be on the last slide for you.
Thanks, Reaza. I appreciate that. Sorry.
All right. So you can see the minimum loan amount. I didn't put a maximum for seconds. And the reason for that is, as long as it makes sense to us, we've done $400,000, $500,000 seconds for people that were buying other properties, putting down payments, injecting money into their business, things like that. So as long as it makes sense to us, we're going to be fine with it. Let's jump into commercial real quick. Commercial, it's probably taken a real beating this year, right? With all the businesses, unfortunately, but the program's still there, and I think it's very useful for you. Minimum loan amount, and this is something to key in on because the B lenders have mostly set their minimum at 400,000 to 500,000. So there's opportunity there. You know, if your client needs a loan amount of 250 to 500, we can help in that situation because they're going to fall outside of the scope of the institutional lenders. But we can go up to as high as 5 million. And you can see the different types of property. If you're not sure what a mixed use property is, picture storefront in the bottom and rental, apartments at the top. Think of the Danforth if you're in Toronto. A lot of mixed use properties down there. That's really the most common type of commercial property that you're going to come across, I would say. So here's what we don't do: gas stations, active farms, grow ops, licensed grow ops. Actually hear a lot more about those these days. We do not finance any of those properties. We don't get it. We don't want to get into the Farm Act, things like that. And then anything to do with automotive repair, mechanic shops, auto body, gas stations, churches, we're not interested in that on the commercial side. Construction financing, it's a program that we have. It's available for you, but we take a bit of a different approach. Most people want anywhere between 75 to 80% on the end value, so the finished value. We don't look at the finished value. We're not lending on future value. So we look at the cost approach, the cost to build plus the land value. We'll consider lending up to 75% of that. We have unlimited draws, and the home warranty is required. So that is definitely a requirement on our construction financing program. Okay, I'm going to jump off of this and keep moving. So this will give you an idea of what our product sheet looks like. Pricing and documentation. The reason we have this slide here is I want you guys to understand, you'll see this in our pricing here, that the higher loan to value, so on this side of the business, the higher the loan to value, the higher the perceived risk is to a lender. So we're going to price differently than something that's less than 65%. Because if we have to take over property at 75% and it's a stagnant market or the market's going down, we're at huge risk of not getting all our investor funds back. And it's going to end up costing us money. And no one ever wants to be at a loss if they have to take a property. So that's why you're going to see pricing is going to be different at a higher loan to value. And we may ask for a little bit more. We don't ask for a lot, but we may ask for a little bit more. You can see our fourth quarter comeback special, which runs till December 31st. If no one's connected with me on social media, connect up with me. You'll see the videos that I throw up there about our promo specials and everything else. But this is the special pricing we have. You guys need to understand that when we approve with no lender fee, what we're telling you is the yield that we want to achieve on that file. And then you can mix and match rate and fee to drop the rate. So the example here is, on a first mortgage under 65%, 699, or you can drop it to 499 plus 2%, or anything in between. You can play around with it based on your client's needs. If they need better cash flow and they don't mind paying a lender fee, do it. But I'm going to suggest to you guys a couple things. Private lending is short term. It's to fix a client and move them out. So if it's for a year and potentially even 2 years, but if it's for a year or less, having the client not pay a lender fee is actually in their best interest, because you got to remember that lender fee comes right off the top and they'll never recoup it. When I say never, they say never say never, but when you run the numbers over a year for the difference in payment, it's very difficult to recoup that. So deal submission, let's talk about that. I'm going to put it to you guys this way. It's as simple as filling in the blanks on the application. That's it. Fill in all the blanks, and really good notes to our underwriter to actually explain the situation. Assets are important, and here's why. When our underwriter looks at your deal, what they're looking for is a comfort level that your client has some ability to pay. Unless you're doing the equity program, then we don't really look at that income side of it, but we still want to have a good picture on the application, as detailed as possible. But otherwise, it's all about cash flow, above 65% for sure. It's all about that comfort that for the time that they're going to be with us, they're going to be able to pay, and then you can exit them. Most exits are to the B side. So that's where they're going to go.
Reaza,
Uh,
sorry, I told you I wouldn't interrupt you again, but
Go ahead.
Susan just asked a quick question here. She's just wondering, can we submit direct on boss to you? That's the question that
Susan,
most people
you're
would have.
jumping ahead in my presentation.
Oh, sorry.
And the answer is yes.
Oh, sorry. Oh my God, I ruined
That's
everything again.
okay.
My apologies.
I love
Okay,
it.
you go ahead.
Okay. Stay on, but just so you guys know, it is actually fairly new that we were finally able to get all of that connected. And I think it was last week. I just got the update that we had our very first deal come through the boss system to us, and it's all connected now. So it's great and it's nice and smooth. What was I going to say here? Oh yeah, tell us about the broker fee, and I'll get into this as well because there's an important document that you have to fill out. But prior to the commitment, tell us about your broker fee, because we're going to collect that for you. With us, you don't have to do a letter of direction. You don't have to deal with your client's lawyer, because our lawyer actually holds back your commission, and we protect it that way. So we make sure you get paid. Okay. Let's see here. Oh, this form, I just wanted to show it to you as an illustration. We're actually working on something that we're going to get out to you guys. Hopefully, I don't know, maybe by the end of this month. But this was something that was used when we were only doing email submission. Uh, it was just a deal submission form. You can actually use this almost as a template of notes to underwriter. And if you cover all these areas off, it'll make it a very smooth transaction with the underwriters, because it'll answer most of the questions that they're probably going to have on your file, aside from some maybe detailed items about the client. So this is the important one. This is how you get paid. In the commitment package, you're going to see this form. So you're going to send back the signed commitment with this document, and you as the mortgage agent can sign it. It doesn't have to be the actual broker, and then make sure you indicate what network you belong to as well, because we track all of that stuff, and that's how I know how much you guys have done with us all year. So very important paper. You want to make sure for all that hard work that you did, that you're getting something out of it. Just some real quick facts. Yes, electronic signatures, absolutely. We were accepting them before COVID. The nice thing is now the whole industry is finally on board with it, from lawyers to you name it, right? And it actually has opened up an area that I'll talk a little bit about with you, foreign buyers. Or a situation that I came across the other day was a family member's here. There's 3 of them on title. The adult child is here, and the parents had gone back home, and now they're stuck back there. But they're on title. All 3 of them are on title. So they want to do something. We're like, yeah, no problem. And it can be all done through electronic signature now, and witnessed by lawyers and all that fun stuff. So it really opened up some really good things there. Your client does need to use their own lawyer, but they are responsible for both costs. We have our lawyer. Our lawyer cost is anywhere between 12 to 1800, and then whatever the client negotiates. I mentioned before, full appraisals, absolutely. Here's our appraiser list. We have it on our link. You can always jump on FISGARD.com and find it there. If for whatever reason we don't have coverage, or the appraiser is just way too busy to order direct from, you can always use either NAS or Value Connect, and you can order through those services as well. I'm going to skip over the other one. You guys don't care if it's title insured. Who cares, right? From your perspective, we care. But they all are title insured. But here's an important one. How many people know what a CMA is, or have ever come across it? I won't ask for a show of hands because I can't see it anyways, but Scotty, comparative market analysis. Let's address this real quick. We do one for every single deal, no cost to you or your client. But what this is, an appraisal is a historic opinion of value, right? It's a historic look. They're looking back 3 to 6 months, comparative sales. What this is, a CMA, is what's happening on the street right now, or at least in the neighborhood right now, and does it compare to the value? So I want to explain a little bit of a process to you guys. It is completely separate and independent of the appraisal. The CMA and the professionals we engage do not have a clue on what the appraised value came in at. Over the last 3 years, I will say we've come across maybe 6 or 7 instances where the CMA is off from the appraised value, anywhere between 50,000 to 250,000. Um, and in every case, it came down to the appraisal and the comparables that were being used. Again, it's a historic look. So when we really looked at it, does not mean it's a dead deal, because what we'll do is we talk to both sides. If they can come to a consensus, then we're going to come up with a value we're comfortable with as a corporate value to get the deal done. And in all instances, we've been able to do that and still make the deal happen. All right, let's get into some meaty stuff here. Forget about the product now, unless, and listen, if you have questions about product, please write in there and I'll address them. And then after the fact, if you want to reach out to me, more than happy to speak with you as well. But before I jump into this, I just want to make something clear. I'd mentioned earlier, we lend from BC to Ontario. If I just address the Ontario market here, when you think of Ontario and where we lend, we're not the super rural farmland, really large acreage type of lender. We take a house and 5 acres for valuation. We're not a cottagey type of lender as well. There are other mix that specialize in that and they're really comfortable, and they've been doing it for 30 years in Ontario. I could more than happy to refer you there. But if you can think of a map, Windsor in the west along the 401 corridor, all those centers there, going all the way out to Cornwall and Ottawa in the east. From the US border, so Fort Erie, St. Catharines, Niagara, Welland, all the way up north to actually we have 5 centers. So Sault Ste. Marie, Sudbury, North Bay, Thunder Bay, and Parry Sound. From there down, it's a dead zone for us, all the way down to Bracebridge, Huntsville. We lend in Midland, we lend in Penetang, Barrie, Aurelian, across the top there. Loan to values vary just because of the size of town and the economics surrounding it. So with that said, I'll also include in that email out to you guys a list of preferred towns that we like to lend in, but it's not limited to it. Because if you have a location, a smaller center that's maybe 10, 15 minutes outside a larger center, we might consider that. Okay. We might not consider it the max loan to value, but we might consider, I want to hear from you, because over the last 3 years, we've opened up a lot of towns in Ontario just based on the activity and feedback from our brokers. Okay. Mixed versus private, there's a big difference here. I explained to you, we've been in business 26 years. We have roughly 25 to 26 employees. We have our investment arm that looks after almost 3,000 investors into our operation, that we have to follow all the regulations. We're regulated by the Securities Commission. We're not regulated by OFSI. Okay. So the way we lend, basically, our investors enjoy that, the way we lend and what we pay them as a return. So that's our business model in a nutshell. But we have collectors and everything else. When you deal with us as a MIC or well, shouldn't say every MIC out there. Everyone's set up a little bit differently. When you deal with us, you don't have to fill out the Form 1 that you typically do if you're dealing with a private individual investor, the Know Your Client investor form. You don't have to fill that out because we've done that for our investor. It's our money that we're lending out. when the file hits our desk, our underwriter's desk, we're the ones making the decision on whether we're comfortable lending or not. That file doesn't have to then just go to an investor to sign off, to cut a check. We have the money. We assign it or we don't assign it. So there's a lot of detail in behind the background there. Versus an individual investor. And if we get into this, there's a couple layers that maybe you're aware of, maybe you're not. A lot of them are not sophisticated. Okay, I want you to think about this. If it hasn't happened to you already, it's going to happen at some point when people find out what you do. They're going to say, hey, I've got $100,000 sitting in my savings account making 0.25%, or it's sitting in a GIC making 2% or 3%. I hear I can get an 8% return on a mortgage. I want you to take my money and lend it out, whether it's on seconds or firsts or whatever. That's an individual private investor. By the way, it's huge risk because you're liable. All right. If the deal goes sideways and the client stops paying, I want you to think about, is it the investor that's going to go knock on that client's door and ask for his monthly payment? Or are they actually going to come to you as a professional that placed the money? If it goes bad and we end up going to court and under power of sale or foreclosure, a lot of these individual investors don't even think that far, right? So you really need to understand that there's liability there. When it comes to E&O, I want you guys to remember this. Errors and omissions, the providers, what they've found is over the past few years now, 75% of their claims have come from private individual investor files. And that's why if someone has a higher mix of that in their annual reporting, chances are the E&O premium is going to skyrocket. And it's already happened. I know it's happened to brokerages, individuals, networks as well. When you do your annual reporting, now they're asking what's your mix of A business, B business. It used to be just straight private. Now they want to know how much individual investor business you're doing out of that private bucket, because they're keying in on that. They realize there's a lot of loss in there. So protect yourself. If there's an option to deal with a MIC, whether it's us or anybody else, it's actually in your best interest and your brokerage's best interest and the network, the best interest there from all facets of the business. If the deal goes sideways, we're the ones collecting. We're the ones that made the lending decision. We're the ones responsible. If there's a loss, we still pay our investors, but we take the loss as a company. So anyways, I spent a lot of time there. This is a slide that is near and dear to my heart. I was created about 2 years ago. And the reason for that was there's an influx of capital into this space. And quite frankly, I felt there were a lot of people coming into this space simply for opportunity. It was an opportunistic move, and they didn't care whether it was good for the client or not. They didn't care whether it was good for your business or not. And so I created this as just an item for you guys to utilize, whether you're thinking of dealing with a MIC, and I encourage you to ask me these questions. It's all about transparency and understanding what you're going to put your client into, but also understanding who you're actually dealing with as a lender. And are they actually the lender? Because I took a call this morning from a broker and they were really upset because the file that they want us to do a year later, they had placed and later learned, actually at the closing table when the client was at the lawyer, that it wasn't closing. The registration wasn't with the person that they thought or that they'd originally placed it with. That person was just another agent that went and sourced the business from an actual lender. But in their advertisements and everything else, they present themselves as a lender. And that's something you really, really need to be cautious of. Because in that specific case, it cost the client an extra 2.5% in fees. That's what happened to that client. Luckily, the client stuck with his broker a year later, and he's going to take care of him now, and do the right thing. But he learned his lesson last year with that move. So he's digging a lot deeper. I'm going to jump down to, important one is, why would you renew? Like, or do you renew? It's important because if the lender doesn't renew, then you need to probably figure out a year later, that you might have to place your client with another private lender. And they go through all the costs again: appraisal, legals, your broker fee. You have to get paid. But that's if they don't renew, that's why. But if they do, is really, really important. You need to figure out and understand what that cost is. And like I said, I've been cataloging. I've seen in writing, um, 19,500 as a renewal fee. And that gets capitalized, it's added to the mortgage. And for that client, remember, these are interest only payments. So that client now has a mortgage balance that's higher by 19,500, which means their monthly payments are going up because of that. And if your client is in that, that circle every single year, what's ultimately going to happen is they won't be able to afford the payments. And guess what's going to happen? They're going to lose their house. And I will use this word, predatory lending. It exists out there. It exists in the individual private lending space, and it exists in this space that we're talking about right now. And predatory lending is simply loaning to own. They don't care if the client can pay. And I had an experience 22 years ago when I first, or 21 years ago when I first ran my first branch, and I came across one of these guys as a private lender. And I learned from then all the way through, just be cautious. So the last piece here on this one, I'm going to say to you, you're probably thinking it's a stupid question, but why would you ask a MIC what they pay their investors, right? Like, why would you even ask them that? So I'll tell you why. There's two things that come out of this. If you're seeing a MIC advertised to you, 599 plus a 2% lender fee, you have to do the math. It's not about rate, as I say in the header here. It's about the yield. Okay, that's an 8% yield. So 6 plus 2, 8% yield. If they're telling you they're paying their investors an 8% return, so the question becomes, how are they making money? You need to understand that piece, because how they're going to make money is the item above that last question. The second last question: what does the discharge fee look like? What does the late payment fee look like? The renewal fee? That's how they're making money. They have to. It's the only way. So Scott, I'll ask you this question. What do you think a late payment fee is on the A side of the business, like the bank side?
Well, the bank side, I mean, that could be like on the bank side, probably I'd say, what do you mean? Well, I don't know. I've never had one, so thank God to do that. But on the
If you
ballpark,
guys saw it,
5% maybe.
no, like just a late payment, late
Oh,
payment.
late payment. I don't know.
Yeah,
I don't know.
late missed payment.
I don't
And
know. I couldn't tell you.
okay,
Susan might know.
so you're looking at, oh yeah, Susan, are you there? Or are you fighting with Bell?
Thanks. Michael Sugar says $50. Trust company's $100.
Michael Sugar. Nobody.
Michael knows.
I love it. So
Private's $250.
50, yeah, banks 50 to 75 bucks. B-side lenders 250 to 350.
Same as like a late payment on like a, say like a, or sorry, an overdraft payment almost in some cases, or a missed payment.
It's bottom line profit, right? For these companies. Late payment, missed payment on this side of the business with the mix that I've seen and cataloged, anywhere between 350 to as high as $750. It's that's how they're making. They have to, in order to make a profit, right? And so again, it's understanding how everyone's business model is set up. And I'm not telling you not to deal with any operation. I'm just saying, understand who you're dealing with and how they're set up, because it will impact your client. The exit fees are what will get your client. And what'll happen is, the guy I told you about this morning was lucky. His client liked them enough to come back to them. Guys, I get calls almost every day asking if we'll pay out another private. And the answer is yes, if it's in the client's best interest. But then they go on to say, I didn't place the client there a year ago. So that tells me the client is not, so first of all, the lender is not getting that business back. The client does not want to deal with the lender. And more importantly, the client does not want to deal with the original broker. So the original broker is losing that client outright a year later. And that's, I don't know about you guys, but if you want to build a business, that's really not my idea of business, right?
No.
So this will be available to you as well as one of the slides I'll send out to you. Susan, you can submit to us through Mortgage Boss. Velocity. That last email address. So once you electronically submit to us, so application credit bureau, you can then send any supporting documents you might have, email it to newdeal@fisgard.com, and then just in the subject line, match it up with the client name and address.
And so, Reaza, before I forget, is the application form available on the FISGARD website, or does it have to be taken through you? We had a question about that before. So.
Yeah, good question. No, it needs to come through electronically. So you're filling out either Filogix or Mortgage Boss application.
Perfect.
So actually, this leads to, it's a good question. A lot of people, I get this question, not so often anymore, but they're like, hey, I've never done a private deal before. Like, how do I submit it? Like, what do I do? And so my answer is, have you ever submitted a file before? Have you ever filled out an application before? Because it really is as simple as that. You're submitting a file to any other lender that you deal with on the A side or the B side. Same thing in Filogix, or I haven't seen the Mortgage Boss stuff, but in Filogix, you just have to change the lender type to private, and then you'll see the lender drop down list.
Wonderful.
And then I'm sure you can talk to the Boss system on what you can find. But I know we're in there. We've always supported the Boss system on that and available. What was I going to say to you? I just had something pop in and I totally forgot. So that's the end of me. For that boring presentation. No, listen.
No, it was good, Reaza. That was great. We had a lot of input on the side here too. And I just wanted to let you know too, we had a couple so Zainab came on, she's working with 812. And
yes.
She let us know that they were on a call before, that's why. So we missed it, but I've recorded the whole thing here at Reaza. So I'm sending it over to them as well. So if there's any more questions that come up, I'll definitely direct them towards you in that sense. But yeah, sorry to interrupt you.
No. One of the things, and I kind of touched on this, but I want to talk to you guys about presenting a deal. So, Scott, I'm going to pick on you because you're unmuted, but if you want to unmute everybody, it's up to you. But when you present a deal to an A lender, what are you really focused on? Just so that we can talk about it with the group.
FC's of credit, I guess, would be the one thing I'd say right there. But you're looking at that person's, payment histories, their bureaus, their income, all those, the check boxes of the perfect box deal, right? So that's just a few. But yeah, you're looking at the person's credit really, and their income and their ability to pay.
You're really focused, and I know, listen, there's no secret. I know most of you do a business primarily, and that's cool. That's 75% of the industry, the business that goes on in the industry. But, when you're presenting a file to us or any other, whether it's an alternative lender or a MIC lender, I want you guys to flip that script. Okay. So when you're presenting to the A side, you're talking about the client, how great they are, their credit, really their strengths of the client. And then of course the property comes into play. Flip it. I want you to talk to me when we're talking or you're emailing any one of us. Start with location.
Marketability.
Yeah, it's all about marketability. So location, the property, the loan to value, and then we'll talk about the client, because we don't have a minimum beacon score. All right. So I've seen clients that have 800 beacon score. We've seen clients that have 450 beacon score or no beacon score. It's okay. But keep in mind, we price for the risk. So if they have a 500 beacon score, we're still, doesn't mean we're not going to do the deal. We'll price for that risk of payment history, but we're focused on the asset because that's all we have. All right. We have limited number of amount of capital. We don't want to lose it if we have to take that asset.
Exactly.
That we have to go on. Okay.
Okay.
So that's really where the focus is.
That's great advice on that reason. We might lose a few people now as it's coming to the 2 o'clock marker here. I think there's people that might be jumping off. So I just wanted to just say, like, if there's any questions before you jump off, if you have to jump off right now, Reaza, are you coming to, are you finished up here? Or are you?
I'm available for you guys. If you
Okay,
want
good. Yeah, no, because if anyone has questions, Reaza did say he'd be.
Presentation's done.
Reaza, the only thing I might add is just that what's your exit strategy? And that's the one thing I think a lot of people, we're not doing this to put somebody in a never plan when it comes to privates and mixed. So definitely the marketability of the property is first and foremost, but to comment on the exit strategy, you want to know that. So you want to know when you're going to be able to get your money back out.
Yeah. Like I said before, it was just short-term lending. And short-term lending can mean a year, it can mean 2 years. But there needs to be a vision of a plan in place and a reasonable one. One of the reasons we may not choose to lend in certain areas, or we only lend to a certain loan to value in certain areas, is because the B lenders may not lend in those areas, or they may be restricted on loan to value in those areas. So if the exit lenders are not there, why would we do that deal?
Right.
All right. It wouldn't make, as a lender, it wouldn't make sense for us, for our business. The exit, it's good for everybody. I need to make sure you're clear on this. Is number one for us, if we don't see an exit, we're probably going to tell you we're not interested in the deal because there's an exit, and we'll be upfront and fully transparent about that with you. Number two, it's good for your business because you get to deal with your client a year later or even sooner, and hopefully get to move them into financing situation that is literally half the cost. And if you can do that for your client, they're going to stick with you forever. And then lastly, as I mentioned, it's good for the client because they are going into a better financing situation, and you can guide them through that. Because a lot of people I've ever seen in my years doing this, the biggest thing is someone hasn't actually shown it to them. They don't realize it's achievable, and no one's actually sat down with them and said, okay, this is what you need to do. If you follow it, you're going to be good. You need to do that for them, and they'll follow you.
That's a great point, Susan. Thanks for bringing that up too. So yeah, that's wonderful. Is there any other questions, guys? We have Reaza for a while now, but I'm sure if there's any extra ones, you can see his FISGARD email address below there. There were a few people that jumped off, Reaza. That's why I just want to let you know they would say we have one from Michael Sugar, says that you are a treasure and a resource to the private lending world. So I hope that helps you. I hope that gives you a little bit of happiness in this conversation. Thank you, Michael Sugar.
I love sugar. I love sugar.
Oh, look out there. The cats are up now from the nap. So you're probably.
Oh, yeah. Sorry, guys. I just took the presentation off. Yeah.
So, I know you had a lot that you wanted to talk about. Did you get everything you needed there in terms of what you were looking for?
Yeah, I don't know. I think I've submitted quite a few.
Right.
I'm not really sure why I don't do well on the submissions, but I think Reaza will call me after and maybe.
Oh, I think he will too.
Yeah, I think he'll give me a call.
Yeah, the main thing is always I'm here for you guys to reach. I'm your main contact for Ontario, Manitoba, but the best thing is either a quick phone call or an email. Let's start out with where it's located, property type, and what you're looking for, and I'll be able to tell you pretty quickly whether it's something.
I'm always at 80%, so I think that's where I fail.
Okay, well, that's
80%. So that's where, and that's why I started working on bundle partners. There are always lenders that are willing to come in behind us, but we're actually creating a bundle program, and that will allow us to say, okay, we have a solution for 80% or 85%, and